Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory, and we thought we'd come to you today with a little bit of a market update, let you know what's going on out there. S&P 500 is currently at 4260, having a little bit of an off day. We touched right around 4300 earlier in the week, and we're giving a little bit of that back. But we've been kind of between 4200 and 4300 now for a couple of trading days. Past several trading days, we've been within that range, which is obviously well off the lows that we were talking about in mid-June. So it's nice to see a lot of that recovery. And a lot about that recovery has been driven by earnings season. So we are now at the very tail end of earnings season. We've got about 460 companies within the S&P 500 that have reported. And earnings season has been very, very positive. Earnings are up 8.5% for the companies that have reported year over year, on the back of 14%, actually 14.3% if you want to get very precise, growth in revenues. That is well above the sort of published analyst consensus numbers. So that was 3 and 10, respectively. So 8.5% earnings growth versus 3% earnings growth is obviously very, very positive. And what I think is even more important is, coming into the quarter, I think there was a lot of noise in the marketplace that analyst expectations for earnings for these companies were just wildly optimistic. And so the shadow forecast, the whisper forecast, if you will, or the whisper expectation was that most companies would be missing because, after all, how could it be possible that these companies would be continuing to post, year over year strong gains in earnings in the midst of such an inflationary environment with all these cost pressures and labor cost pressures, et cetera, et cetera, et cetera? And I think the answer is not only are they continuing to post solid earnings, but they're actually thriving in that environment, which was largely unexpected. And I think that has been the primary driver for why the equity markets have rebounded so strongly here in July and early August. In terms of the go-forward macro sort of narrative for the market, we continue to be, hoping for the sort of Goldie Locks scenario, right? So on the one hand, we've got inflation that's out there, and that is by far and away the biggest peril, I would say, facing the financial markets and retirees, candidly, going forward. Everyone understands that we need to get inflation under control, and we've seen some recent sort of good news on that. But then on the other side of the house, we have, the R word, recession. And the question is, in order to kill the inflation beast, do we have to have sort of a mini recession or a light recession on the other side of it in order to shut that down? And I think as a result of that, we get this sort of good news, bad news, is it good news, is it bad news type information flow coming out. So, for example, we are starting to see the interest rate sensitive sectors of the economy slow. So recent mortgage data has been declining year over year, declines in applications for both refinancing and for new building permits, new purchase mortgages, et cetera, indicating that the housing sector is slowing. I just note for everybody that it needs to slow down. If we're going to see housing prices, stabilize, then it can't be the case that every time you sell a house, you put it on the market on a Friday and have 15 bids for it by Sunday afternoon. We need that pace to slow down. In the meantime, when you see that slowing data, there's always the question of, is the market going to interpret this as a good thing because it indicates that we're starting to cool off a little bit? Or are we going to interpret that as a bad thing because it means that, the economy is contracting? And I think for us, that's kind of a day-to-day flow, depending on how the market's feeling of, is bad news good news or is bad news bad news? And we'll continue to see that kind of data flow out there. In terms of hard data that's most recently come out, I would note that our most recent CPI report, which is the direct gauge of inflation, did show a decent amount of cooling across both the total number and in particular in the core number. So that's a positive sign, and we'll have to see where that evolves to over time. As always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great week, and I look forward to talking to you again soon.
Thank you for tuning in, and if you're enjoying this content, please don't forget to subscribe and click the bell so you can keep up to date with everything new at RFG. If you want to learn more about who we are and what we do, please visit our website at rfgadvisory.com.